Welcome back to the channel. We are here today to discuss and really answer some things that many buyers are coming to me with questions about. And that is, hey Michael, I'm thinking about buying a house. What is the right type of loan for me? I've heard of FHA, or I've heard of USDA, or maybe even conventional. How do I know which is the right loan for me? So we're going to discuss each of these different types of loans, the benefits, maybe positives and minuses for each type of loan, and then you certainly can choose what loan is best for you as you're going through that. But most importantly, it's really crucial that you work with a lender that has the skill, the experience, and obviously the care to make sure that they go through all these options with you, or at least tell you why they've selected an option. Like, I don't go through every one of these loan options when someone is not a veteran. We don't talk about VA loans. So stick around for this video, and hopefully by the end you will know what is the right type of loan for you as you go through the process of buying a house. So the first type of loan that we're going to discuss is one that I think most everyone has heard the name of. In fact, it gets confused a lot as a first-time homebuyer program, but it in fact is not. So what is an FHA loan? So FHA loan is Federal Housing Administration. It is part of HUD, which is Housing and Urban Development. It is a government-insured loan. So the government's not issuing the loan, they're just insuring the loan on behalf of the lender. And it is a great loan. I'm very careful when I explain this to clients, but it's a great loan if it's the only loan you can get. I say that because most FHA loans have more costs associated with them than some other types of loans. So when people come to us at the Martin Mortgage Group to determine what loan they're looking for, we're pointing them in the FHA direction if they have a lower credit score, meaning less than 700. We may even look at it in the 720 range now, but somewhere in the 720 or lower would be something we consider. If you've got higher debt ratios. Now some people, their circumstances, we may not be able to count all of their income. Maybe they're newer commission people. We can't utilize that commission income until they've been there 2 years. Maybe they have bonuses we can't count. So there's different reasons why someone may have a higher debt ratio. One other very important reason why someone may have a higher debt ratio is because they have a spouse that is buying with them, but we can't utilize their income. Maybe they're newly self-employed. So lots of reasons why someone may want to get a loan with a higher debt ratio. Really, sometimes we can get into the upper 50s, where a traditional loan is not going to allow greater than 50% debt ratio, and usually wants to stay somewhere around 43%. Now, to be clear, by the way, debt ratio is a term we utilize for debt to income. It is your total monthly obligations, anything that would show up on a credit report, like a car payment, student loans, credit cards. Add those monthly payments up, add the new housing payment to that, and then divide that into your gross monthly income, and that's your debt ratio that we were just referring to, or debt to income ratio. So that's a great reason why you might want to utilize or look at an FHA loan. There is no first-time homebuyer requirement, as many people think that there is. Hey guys, I just wanted to take a second out of the content that we're shooting and sharing with you to ask you a favor. If you like what you're hearing, please be sure to like, subscribe, and if you've got any kind of questions about anything we're talking about or other topics that you'd like us to discuss, be sure to drop those in the comments. We'll be sure to respond to you and love to add another video that will help you in what you're looking for. Thanks so much again for taking the time to watch our video, and we really appreciate you sharing this with others. Another great loan option if you live in a rural area is USDA. That's U.S. Department of Agriculture, just like the beef company, just like folks you think about farmers. In fact, we used to refer this as a farmer's home loan. Now, this type of loan is very specific to certain areas, and if you think of any kind of major city, you're not going to be able to qualify. For example, if you're in Wake County, where I happen to live in Raleigh, most of Wake County does not qualify for a USDA loan. The very small part of the outskirts might, but they are very few and far between. Now you're starting to get a little bit more rural counties, and most of the counties outside of Wake County are going to have a large option of USDA type loans. Great benefit of USDA loans is that we can do 100% financing, so no down payment required. It does have very low monthly mortgage insurance as well, which is another benefit towards that versus a conventional or FHA loan. USDA loans also have income requirements. So a reason why you may not want to utilize a USDA loan is that you may make too much money, and they actually don't just count the person on the loan. Anyone living in the house, we have to get their income on top of that. So if a son or daughter that are working part-time, their income would need to be qualified. And if you go beyond your household limit, then you would not be able to get a USDA loan. So who would be the ideal buyer for a USDA loan? Someone who'd like to put a minimal down payment, someone who has good credit, but not necessarily the best credit, and someone that is looking to buy in a rural area. USDA is perfect for that kind of buyer. And we love to find those types of buyers and pair them with that mortgage because it's one of the best deals out there for that particular buyer set. A third option is VA. So in order to qualify for a VA loan, you have to be a veteran or be in the military currently. There are great benefits to having a VA loan. Again, this allows up to 100% financing. There is no monthly mortgage insurance. There is usually a VA funding fee that's financed into the loan, but if you happen to be a veteran that has 10% or greater disability, then that is waived entirely. So a VA does not have a loan limit, so you could literally finance $1 million, $1.5 million if you're buying that property, obviously, and you qualify for that much. A VA loan is generally fairly easy to close. There are some sort of negative stipulations with a VA from a listing agent or seller standpoint. Sometimes the sellers believe or listing agents believe that the appraisals are going to be a little more stringent, and they are protecting the VA buyer, but it's rare that we have any issues with VA appraisals. And to summarize, that VA loans are for veterans that can finance up to 100% of the purchase price, and is really one of the best benefits that veterans have when you're looking to become a homeowner for the first time. You don't have to be a first-time home buyer, but it's a great option when you don't have that down payment because we can do 100% financing. So the fourth option we're discussing is conventional financing. If you've heard the term Fannie Mae or Freddie Mac, those are the investors for conventional financing. It means these loans will be sold to Fannie Mae or Freddie Mac once they are closed. Most of the loans we do in our market are conventional loans. Conventional loans are generally going to have the best terms, at least if you have a great credit score. We can finance for first-time home buyers as little as 3% down or 97% financing for a conventional loan. We can also do renovation loans for conventional loans. There are many options available. Typically, you're going to have some of the lowest interest rates, and typically you're going to have the lowest mortgage insurance if you've got great credit scores. And certainly you can avoid mortgage insurance entirely if you put 20% or more down, or once you get to 20 to 25% equity in your home, then mortgage insurance can be removed for the life of the loan. So who's a buyer traditionally for a conventional loan? Typically, it's going to be someone who has very income that's easy to verify, traditionally somewhat of a stable income, although we can utilize variable types of income for that. Usually great credit scores are going to be 720 and above is ideal for a conventional loan. And sometimes, by the way, we don't even need appraisals for conventional loans if you've got a decent down payment, 20% or more, so we can avoid that extra cost as well as the potential risk that might come along with a low appraisal. Again, majority of our clients tend to utilize conventional financing. Here in the Triangle, right, we're in the Research Triangle Park, many of our clients are some type of engineer or some type of someone that's involved around the medical world. And so majority of our clients tend to go in that route. But what the great news is we have all kinds of loans to serve each buyer individually. Now, the fifth type of loan is a jumbo loan. Now, Jumbo loans are for any loan amount that's above what we call the conforming loan amount. Currently, that number is $766,550. More than likely, that's going to be increased this next year, as it has most every year. And as we see those numbers rise, then the jumbo amounts will rise. So any loan above that amount is going to be considered a jumbo. Jumbo loans naturally are bigger, right? They're bigger jumbo loans. But what's important to know about a jumbo loan is that they can be a little bit more stringent. And so you really need to make sure you work with your lender to meet the criteria to qualify for a jumbo loan. If you're looking to purchase a $1.5 million home and want to borrow $1.2 million, then it's really important that you get to a lender ahead of time to make sure all the criteria fits. Just a little bit more stringent, you can imagine, they're much larger loan amounts. There is one other type of option which we're not going to go in today, non-QM, which is non-qualified mortgage. Now, these types of loans have many different types of investors. Again, we'll go into that in another video. Would love to share how we might be able to fit you into one of those programs if one of these other ones is not the right fit for you. These other options tend to have better terms than non-QM loans, so we generally go to those after we've gone through all these other options first. So I hope that this has been helpful to you to understand what might be the right loan as you navigate the home buying process. It's extremely important that you do run this by, obviously, the experts, a lender that's been in the business for years and has a lot of experience to be able to help you choose the right loan for you and educate you why one loan might not be as good as another. If this has been helpful, certainly love for you to like this video. If you haven't subscribed yet, we'd love for you to subscribe to get our future videos. And of course, if you wouldn't mind sharing this with someone you know that's thinking about purchasing a home, we would be very, very grateful. Thanks so much.